Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. Paul Winkler. Talking the world of money and finance. The topics of the day, topics of the week, questions that have come in. As a matter of fact, if you have a question, paulwinkler.com/question. Very creative. paulwinkler.com/question. And of course, the website is where you find all kinds of content. I had a conversation with a guy this week and we were talking about that and just talking about the radio show and the website. And he said, so you have all different types of topics. And I says, yeah, pick a topic, any topic. and he named a topic. And I went to the website and I typed into the search engine that topic. And it was like 10 different audio segments came up on that topic. And it was like, wow. I said, yep, that's kind of what we do on that website. There's just about anything that you might think of asking about, I have covered in great detail on there. So you can check that out, paulwinkler.com. Now, question came in, and it was from an article on in Yahoo Finance, and the question was, I know what your responses will be. You know, somebody that listens to the show on a frequent basis would probably know what my responses would be on things, because, you know, the one thing is if you follow academic research, you don't change things all the time. You know, constantly the media is coming up, oh, you need to do this now, you need to do this now, you need to change this. Oh, this is the thing that's hot right now. And, you know, the reality of it is you're just chasing your tail when you do that. You're chasing after yesterday's winners when you're constantly looking at what did well yesterday, and you're behind the eight ball. It's like the horse already got out of the barn, as I like to say. But he says, know what your responses will be, but I need the comfort of your thoughts to get over this. And it's because the media can be unnerving in how they put things out there. And it is easy to get into the thought process that the world is different now. It's so easy because it seems different. There always seems to be something new that's happening that hasn't ever happened before. And as I often say, that history doesn't repeat, but it rhymes. So you may be seeing the latest calamity out there and the latest problem, the latest situation where one country is invading another, or where one country is doing something economically that they shouldn't be doing, or when they're dealing with something and the media will say, this has never happened before. And the reality of it is, yeah, maybe it never has happened exactly the way it's happening, but it's happened before in a little bit different way in the past. You know, it's like, for example, inflation. This is, you know, you may go, wow, this is like really, really new. And you hear things that, you know, we haven't had this happen in 40 years. You know, and yeah, true, we haven't. But the reality of it is we did have it happen 40 years ago. And the academic research that I apply and that I talk about here is about 100 years old. You know, so there hasn't been a whole lot that hasn't happened over 100 years that hasn't rhymed to some extent with what's going on now. So hence the reason I use that term so often. But anyway, the article was on the 60-40 strategy is on pace for its worst year since 1936. And then here we go again. It's a worst year since some year in the past, which is academic research, which falls within the period of time the research that I always refer to covers. Because if you look back at the Brinson, Hood and Biebauer research, you look at Markowitz and his research, you look at Fama and his research, you'll find that what they tend to do is go way the heck back to 1926 is very typically where they go back to, because that's Ibbotson and Sinkfeld, one of the guys that I actually followed around the country, Rex Sinkfeld. In Ibbotson did the research, and it was called Stocks, Bonds, Bills, and Inflation. That was actually the research writings that they had done, the book that they had done. And it was all on history of the stock market going back to 1926. So what they did is I can't even imagine. You imagine the level of data that you have to go through going back to 1926 to formulate the return of the S&P 500, small cap stocks. That's a mountain of data that they went through. And then bonds, that was stocks, and then they had bonds, long-term government bonds, intermediate bonds, and And then, of course, they had treasury bills, which are short-term when the government borrows money for a short period of time. It's just a daunting task to even think about going through all that. But they did. Thankfully, they did, because now we can go and look at that research, and then we can pair it up and we can look at various periods in time and what was happening during those times. When good news came out, bad news came out, the government did this, the Treasury did that, the Federal Reserve did this, or they made some other move, or a world war started, or a depression started, or when all of a sudden you have an invasion of a certain land, or you have a sharp currency devaluation, or you have an emerging market crisis, and I think back through history. And there have been a lot of things that have been really, really bad. Oil crisis and energy shortages and tariffs being raised and tariffs being lowered and tax rates being raised and tax rates being lowered. And you look back at history and you go, wow, we do have a lot of stuff to draw from. And we do have the ability to look at what markets did when those things happen. Now, here's the warning regarding that. The warning is to try to predict the future based on that. Because what we're tempted to do is go, well, we've been through these things. We see how markets respond. Can't we look at the news of the day? And can't we make an assessment of how the market's going to go going forward? Because it did that before the last time something like that happened. And you may think that that's a viable way of managing money, but the problem is that everybody else knows that information. So the market will actually respond based on, well, last time this happened, this is what the market did. It went down 5%, let's say. Last time that this happened, the market went down 5%. This happened again, therefore the market's going to go down 5%. Well, it'll go down 5% over the next 6 months, let's say. And maybe that's what it did the first time. It went over the next 6 months, it went down, and it went down over this period of time. Well, now it's going to go down in 5 seconds. It's not going to wait all of those months to go down, because people will be going, oh, what? Last time this happened, it went down 5%. Therefore, it's going to down, and it'll take 6 months, it'll go down 5%, but I'm not going to sit there and wait for that to happen. I'm going to get out now, and they sell to somebody else at a 5% lower price right away. So right away, what will happen is that market will adjust to the new information with maybe the assumption that possibly the same exact thing is going to happen in the market in the future. So it can be confounding to try to get ahead of that curve. Now, in this particular case, they're talking about a 60-40 portfolio. And a 60-40 portfolio would be an income generating portfolio that is traditionally used for that purpose. It's how much in stocks versus how much in bonds. That's what the 60 stands for, is how much are we holding in stocks. And that would be 60% of the portfolio, 40% would be in fixed income or bonds. And the idea has always been, well, you do that, it's a balanced mix so that when stocks aren't doing well, you take income from bonds. And when bonds are doing poorly and stocks are doing really well, you take your income from your stock portfolio and you have a little bit of the best of both worlds. And the idea being that 60-40, why that percentage? Well, there's a lot of research on how to maximize expected return for a given level of risk. And there was a guy, Markowitz, I already mentioned his name. He came up with a way of actually determining how to maximize expected return for a given level of risk in the portfolio. So hence, when he came up with this, this would be on something called an efficient frontier. It's efficient in that it delivers the highest expected return is the way it would be worded for a given level of risk. So hence, if I'm taking income, if I put all my money in stocks, just the S&P 500, well, there's a lot of volatility. There's a lot of up and down. And the up is great. Everything's wonderful when things are going up. When it's going down, if I own shares in something and all of a sudden it's gone down, I have to sell more shares because the price is lower. So if I needed $100, let's say, and the share price was $5, then I have 20 shares, right? Now, if the price goes down to and so I have to sell 5 shares if I need $100. If the share price is 5, I got to sell 20 shares, right? If the share price drops to 4, now basically what happens is I got 25 shares. I got to sell 5 more shares. 4 times 25, 100, in order to get the same $100. So I have to sell more shares, and the problem is that means that I have fewer pieces or shares to actually recover when the market recovers. So there's your problem, and we call that sequence of returns risk is what we have. And what helps us fight that to some extent is having bonds, so I can wait until markets come back before I sell from there. Now, this article is basically saying that it's on pace for its worst year since 1936, according to Bank of America Merrill Lynch. Well, the problem is if you look at the data in this article, it says that the market was down like almost 20%. This portfolio was down 20%. Now, if you had actually diversified, it's down significantly less. The problem is that the portfolio diversification, and they mentioned this here, S&P 500, and they've got longer-term bonds, are down a lot more. And the problem is that's not how you would want to design one of these portfolios. You would not want to design it that way because basically what's happening is with interest rate increases, which is what we've seen year to date, those longer-term bonds, which, they have a higher yield because when somebody borrows money for a long period of time, you charge them more interest. I mean, think about a 30-year mortgage versus a 15-year mortgage. 30-year mortgage, you're going to have a higher interest rate than you do on a 15-year. Why? Because the lender is taking more risk that interest rates will go up. And if interest rates go up, they are stuck lending you money for 15 more years on the 30-year mortgage. So hence, they want to get paid for that. So they're going to charge you more interest. Well, because of that, what happens is the longer term that you have on those bonds, the higher interest rate you get paid, that's all great. But the problem is that when those interest rates do go up, then the longer term bonds drop more. Okay, so that's interest rate risk. So in effect, what happened is they're talking about their research and their 60-40 portfolio being down that much. The problem is the asset mix is bad, number one. Number two, they're saying it's the worst market since 1936. Now, what was happening in 1936? If you think back to that period of time, things were getting pretty, there's a lot of unrest over in Europe at that particular point in time. And with interest rates, starting to creep up and with the stock markets going down because of the unrest, you had some of the same conditions. But here's the issue. A 60-40 portfolio, actually, if it were well diversified, this isn't the worst year. If it were well diversified, it was not by any stretch of the imagination the worst year since 1936. 2008 was worse, actually. That was a much more difficult period of time. But even still, it's not down as much. But here's the thing, is that if you have shorter term bonds in the portfolio, they're not down much, if any, at all so far year to date. So I have that little repository to take my income from, either cash or really short term type of investments. Now, why do we have any intermediate? And the intermediate are down a little bit more year to date, even in a diversified portfolio. Why do you have that? Well, because most of the time, and this is most of the time throughout history, and when you're putting together the portfolio, you're looking at correlation coefficients, how things move with and against each other. But most of the time, when you have big market downturns, and really year to date, the biggest market downturn, the biggest area down is large U.S. stocks, which is kind of a small part of the portfolio. In the way I put my portfolio together, it's really not that big of a part of the portfolio, but that's the worst area of the market. And a lot of areas of the market aren't down really, hugely. I mean, you hear me talk about downturns in the market, 10% downturns in a market, and a lot of areas of the market are down about that much. Well, that happens on average once a year since 1950. So we're looking at something that's kind of a once-a-year event, But in reality, it's not down that much. It just seems, and why you get that data and go, wait a minute, I don't remember it happening all the time. Well, sometimes the markets go down that much, but they don't stay down for very long. It's just when it's down a little bit longer and it's sustaining that down for a while, that's when people start to get real antsy. But probably a topic for another time. But so what happens is that you have this downturn and you go, well, what typically happens if you have a big downturn, and 10 isn't a big one in my mind, it may feel big to you, but it's not in my mind based on, doing this for so long. But when it's down a lot, that's when you start to hear the Fed go, hey, you know what, maybe we need to lower interest rates, to get the economy going again. Because if you have big downturns, it's usually because the economy's gotten really stinky. So what's not happening right now is that the economy's not getting lousy. And because the economy's not getting lousy, there's no need to lower the interest rates, which drives bonds up. So most of the time, I'm going to say when you have bigger downturns than we really have this year, you'll find that bonds typically go the other direction. But sometimes there's these like intermediate downturns, kind of like what I would call this year so far. And that's where your short term comes in really handy in the portfolio. Now, all that being said, even though we had a worse downturn in 2008, there's a whole workshop I had done on this, on taking income from an investment portfolio. If it were well diversified, you did over the past 20 years, you did just fine taking an income, even though 2008 was worse. And the reason being is the design of the portfolio. The engineering is key. How the portfolio is actually put together. So recognize that, Bank of America, Merrill Lynch, and Yahoo Finance jumping in and talking about a 60-40 portfolio on pace for its worst year since 1936. Number one, the asset mix that all 60-40 portfolios are not created equal is really a super key item to keep in mind here. You can screw up the design of a 60-40 portfolio, and probably ought to explain, and I'll do this after this break. I'll talk about why it is that they would design it in a way that I would look at and go, it's not a good design. What's the rationale behind designing it the way they are? And I'll spend a couple minutes on that. Listening to the Investor Coaching Show right here in Super Talk 99.7 WTN, Paul Winkler. I'll be back right after this. Back here. This is the Investor Coaching Show. Paul Winkler. Talking world of money and investing, paulwinkler.com, the website. So back to this article talking about 60-40 strategy, 60% stock, 40% bond strategy is on pace for its worst year since 1936. And they said, the recent synchronized sell-off of stocks and bonds has crushed one of the more popular strategies for long-term investors, the 60-40 portfolio. And it is a very popular mix. It is often a misused mix, as I talked about in the previous segment. It is often invested improperly, not in my opinion, but just based on the academic research and how a portfolio. And I often refer to academic research because it's not people selling investment products. That's why I talk about that. But it was what appealed to me because it was, okay, why does something work? That's why I loved academics, is why does it work? Why does it work the way it does? What is the rationale behind it? I often kiddingly say that I think my mom passed through Missouri when she was pregnant because you got to show me why something works the way it does, for me to get behind it. But, so a 60-40 portfolio, and what happened to their portfolio in this article where it had such bad returns, negative 20%. As of the end of August, why was this so bad? Well, because they loaded up on large U.S. stocks, one asset category. It's one of the hardest hit asset categories for the year so far. And you've often heard me talk, if you listen to the show, how you don't want to do that. Like target date funds tend to do that. They tend to market tilt toward large U.S. stocks. And then it was longer term bonds. And the reason that the longer term bonds, I already kind of explained that the interest rates are a little bit higher, just for the same reason that 30-year mortgages have a higher interest rate than 15-year, but they're harder hit when interest rates rise. Now, why large U.S. stocks? And it has to be, we talk about familiarity bias around here. So I'm more familiar with large U.S. stocks, and I'm more likely to keep my job. If I just want to just keep my job as an investment advisor, the easiest way to keep your job is to load up on large U.S. stocks, because if the market, the S&P 500 and the Dow, that's what most people think of the market, is up and the portfolio's up, job safe. If both markets are down, I'm not happy that the market is down, but job safe because I look like the market. Now, if the Dow and the S&P are way up, and you're in a diversified portfolio where you have large value, small value, and international, all of that stuff, your return is not as high as the S&P, which is hitting record highs. Like, think during the Trump years, that was what was going on. And what would happen is you go, well, wait a minute, the S&P is like knocking the lights out. Why is my portfolio not going up as much? Because you're diversified. Well, that stinks. Well, it doesn't stink when the market does what it did this year so far, which is the S&P goes down more than everything else. That's when you go, oh, maybe there is some reason to diversify a portfolio. Or during the 10 years from 2000 to 2012, where large U.S. stocks had no return. You look like a genius when you're diversified. Or during the 1970s or during the 1980s, or, you can name lots of periods of time when large U.S. stocks were not even near the top area of the market. So that's why, you diversify. But if you just want to keep your job, you don't care about making sure that you have the highest risk-adjusted returns, and that's not your goal to do that for a client, then you just market tilt. And that's what a lot of fund companies do. And the familiarity is it's interesting because it's not just in investing. I was reading an article the other day. I was talking about music. It was like, why do we love music from our youth? And there are physiological reasons, brain reasons why we love the music from our youth. But it was really, it was interesting just talking about how you have areas in your brain that look for things that are familiar, and how your brain actually goes toward that. And that familiarity it creates the release of endorphins and the feel-good chemical in your body. And there is something about something that's familiar that is just attractive. And it makes you feel comfortable, makes you feel okay. And, one day maybe I'll get into that more in detail because it is an interesting topic. But, let's just look at this and say, what's going on with investing? If I go in and I start to say, okay, let me explain to you about large U.S. stocks and, how your portfolio moves, that you're going to feel comfortable right away. But what if I go and I say, hey, wait a minute, let's walk through the logic of owning other areas in the market. And, for example, if you ate the same foods every single day, you would get like really, really bored, right? It would be like, ugh, macaroni and cheese again. I loved it the first time, but the 18,000th time, it's a little bit old. And you look at it that way, you go, wow, variety is a spice of life, as my mother used to say. And then you start to look at your investment portfolio and go, hey, how about if we have a little variety and and intuitively I can get you to go, yeah, that makes sense. But what I like to do is I like to draw parallels to other areas, and I'll use bathing suit sales. And I go, hey, if we just lived our entire life based on bathing suit sales, great and everything. We've had a company that's always sold us bathing suits. It's all well and fine, but it's feast or famine. In the summer, it's feast, and we got lots of sales. In the winter, it's nobody wants to buy a bathing suit, so it's famine during that period of time. But what if we can go and throw in, and now we can start to have winter coat sales in there. Now we've got feast in the winter where we had famine, with the bathing suits, and we've got conditions that are better, that where I have something that's doing okay in multiple time periods and offsetting some of that risk. Now, basically what I've done is I've just taken something that is logical to you that you go, oh yeah, I relate to that. That metaphor makes sense to me. And now I have made it familiar. And this is why I do that. I do that because I want to make it familiar, because I know that if I can get the concepts of investing over to you and bring them over to you in familiar terms, you're more likely to feel good with it and feel okay with it and stick with the investing program when I do that. So that's the method behind my madness. Really, if you think about it, that's what I'm trying to do. Because we do feel more comfortable, and I've got to feel comfortable with my investments, because if I don't feel comfortable with what I'm doing, I won't do it for long, okay? I will not stick with it when things get weird, because all of a sudden I'm going to run to what's more familiar and I'm going to throw all my money in large U.S. stocks. And unfortunately, that's what the industry tends to do. They tend to go that direction because it takes more effort and it takes more time to educate and bring in metaphors and help you become more comfortable with, why am I doing what I'm doing? So hence, a little bit of a tour of the back part of my crazy mind.